AI isn't just about flashy chips and headlines. Behind every AI model is infrastructure, data centers, power, and memory. Today we are breaking down three stocks sitting right at the heart of that AI build-out: IREN, Nebius, and Micron Technology. They've all delivered very strong performances over the last 12 months, up over 200%. But with that upside comes real risk. So the key question we'll cover in this video is, how can you as investors profit from the AI infrastructure trade? So please stay till the end. I'll also give you my portfolio allocation to these stocks, so more motivation for you to stick around. Welcome back to Wages to Wealth. I'm Hitender, and by day I work in credit risk at a major retail bank. My job is to ensure that the bank has enough money set aside if things take a turn for the worse. So for me, it's all about managing risk in a strategic and sustainable manner. Now let's talk about the AI infrastructure story, something a lot of people overlook. AI growth actually depends on three non-negotiable aspects. 1. Compute, which is data center. 2. Power, which is energy efficiency and cost. And 3. Memory. The AI models require a lot of memory. That's why companies like IREN, Nebius, and Micron Technology matter. They are not consumer brands, but as AI demand grows, these businesses sit directly in the profit chain. But the problem here is infrastructure investing is capital intensive, cyclical, and volatile, which is why understanding strength, risks, and positioning matter even more here. Let's start with IREN, ticker symbol IREN. What does IREN do? IREN operates renewable power data centers focused on low-cost energy, high-performance computing, and AI and data-intensive workloads. Power is one of the biggest bottlenecks in AI, and IREN's cost structure gives it a very good competitive advantage. Over the past year, IREN has delivered very strong gains. It's up over 270%, and that's driven by rising AI compute demand, capacity expansion, and improving sentiment towards infrastructure plays. But it's been very volatile. Its 52-week range is between $5 and $76, so it's a very, very volatile stock. Some of its strengths are the fact that it's a low-cost renewable energy company, it is scalable, and it has strong operating leverage, which means that a small sales increase leads to a very large profit jump. Some of the risks are heavy capital investing, funding and dilution risk, which means that the company can decrease the number of shares available to raise more capital, earning volatility, and high sensitivity to demand cycles. From a risk perspective, IREN is a high risk, high reward name in this group. So you need to keep this in mind when you consider investing in this company. Next up is Nibius, ticker symbol NBIS, sitting between IREN and Micron Technology on the risk spectrum. What does Nebius do? Nebius focuses on AI-first infrastructure. It has high-density compute, it has purpose-built AI facility, and specialized data center infrastructure. Nebius has seen very strong upside over the last year. It's up almost 250%, and it's driven by increased investor focus, expansion narratives, and growth-driven momentum. But like most AI players, performance has been choppy. Its 52-week range is between $18 and $141, so it's been very, very volatile. Some of its strengths are direct AI exposure, specialized infrastructure, and long-term growth potential. And some of the risks are very high upfront capital requirements, execution risk, which means performance is dependent on management's ability to execute well, and sensitivities to AI spending cycles. Nebius is a mid-risk growth player, more stable than IREN, but not as established as Micron Technology. Now let's talk about Micron Technology, ticker symbol MU, the most established company in this group. What does Micron do? Micron supplies memory, which is critical for things like AI training, data center workloads, and high-performance computing. AI is incredibly memory intensive, and that's a major positive factor that is working in Micron's favor. And over the past year, Micron has staged a very strong recovery and is up over 200%, supported by improving memory pricing, supply discipline, and growing AI-related demand. The trend has been very clearly positive. Its 52-week range is between $61 and $293. Some of its strengths are the fact that it has a very strong balance sheet, it has scale and resilience, and its cyclical recovery is well underway, and it has lower relative volatility. Some of the risks are the fact that the memory pricing cycles are sensitive, it is macroeconomic sensitive as well, and there is industry oversupply risk as well. From a credit risk perspective, Micron Technology is the most stable name here. So to line these three stocks up, IREN is a high risk, high volatility AI infrastructure play. Nebius is mid-risk, AI-focused growth play. Micron is the lower risk, established cyclical company with AI upside. It's the same theme but very different risk profiles. And this is why the portfolio construction matters even more over here. Before we talk personal allocations, we need to address one critical thing, volatility. All three of these stocks are volatile, but not for the same reasons. And volatility itself is not a flaw. It's simply the price that you pay for higher returns. The real mistake investors make is reacting emotionally instead of managing volatility structurally. Here's the framework that I use. Volatility by itself is not risk. Uncontrolled position size is the real risk here. And the goal is not to avoid pullbacks, it's to survive them without causing any panic. So instead of asking, is this stock volatile? The better question here is, how do I size and manage this position so that volatility works for me and not against me? That mindset shift will change everything. I follow three simple rules with volatile AI infrastructure stocks. Rule number one, never go all in at once. These stocks move fast, both up and down. Trying to time the perfect entry usually will backfire. Instead, split your position into 2 to 4 smaller buys. You will not catch the bottom and you don't need to catch the bottom. Rule 2. Let position size absorb the volatility. A stock dropping 30% sounds terrifying, but not if it's only 2% of your portfolio. Rule 3. Volatility decides sizing. You can be bullish and disciplined at the same time. High belief in a stock never justifies oversized positions. If you're watching these stocks but don't own them yet, here's what you can potentially do. First, consider adding them to a dedicated AI infrastructure watch list, not your main portfolio. The goal over here is observation before action. Second, track only three things. Price relative to the 50 and 20-day moving averages, or earnings and guidance updates, or AI capital expenditure and data center demand commentary. And finally, use volatility to enter but not chase. Strong AI stocks regularly pull back 20 to 40% even in upturns. That's where the risk reward improves over here. So before we move on to my personal allocation, you can check out my 1-minute summary of how you can open an investment account, which will help you in investing in these stocks and any other stocks based on your research. So do check out this video. Also, if you like the content so far, please subscribe to this channel and share it with your network. As mentioned in previous videos, my objective is to build a community where households are financially aware and making smart money decisions. Okay, now I want to be transparent about how I've approached these three stocks personally, not as investment advice, but as an example of risk-adjusted thinking. Please note this is not financial advice. Please do your own due diligence and consult a professional if you need to. So in my portfolio, 5% is allocated to Micron because it's the most established player with a stronger balance sheet and lower volatility. Then 3% is allocated to Nibius because it sits between the three stocks. It has strong AI exposure but still a very good growth infrastructure play. And then 2% is allocated to IREN because it's the highest risk and most volatile. I want the exposure but I size it smaller. The logic is simple here. The higher the risk, the smaller the position. This way I get exposure to the AI infrastructure theme without letting any single name dominate my portfolio. That's the wages to wealth approach. Participate in trends but manage downside risk first. AI infrastructure is one of the defining infrastructure themes of this decade, but it won't be a straight line up. IREN offers explosive upside with volatility. Nebius offers focused AI growth with execution risk. Micron Technology offers a more balanced, established way to participate. The goal here isn't to find the most perfect stock, it's to build exposure intelligently. Let me know in the comments which of these stocks are you watching and how are you sizing your risk. If you found this video useful, please hit subscribe and share with your network. I'm Hitender and let's turn those wages into wealth. See you in the next one. Thank you so much for listening.